When people hear about making money in crypto, most of what they see online is hype, screenshots, and unrealistic profits. But behind all of that noise, there's one place where real traders operate, and that's futures trading. And if you're watching this, you're probably curious about how it works on Binance, and more importantly, how beginners can actually get started without getting wiped out in their first week. So imagine this. Instead of just buying a coin and hoping it goes up, you now have the ability to make money whether the market is going up or down. That's the core idea behind futures trading. You're not just holding assets anymore, you're trading price movements. And that's where things start to get interesting, but also dangerous if you don't understand what you're doing. Let's break it down in the simplest way possible. In spot trading, you buy something like Bitcoin and you own it. If the price goes up, you profit. If it goes down, you lose. But in futures trading, you don't actually own the asset. You're entering a contract that predicts whether the price will go up or down. If you think the price will rise, you go long. If you think it will fall, you go short. That's it. Two directions, and both can make you money. Now here's where futures becomes powerful. Leverage. This is what attracts most beginners, and also what destroys most beginners. Leverage allows you to control a larger position with a smaller amount of money. So instead of trading with just $100, you could open a position worth $1,000 or even $10,000 depending on your leverage. Sounds amazing, right? But there's a catch. Your losses are also amplified the same way your profits are. So if the market moves slightly against you, your entire position can be liquidated. Liquidation simply means your trade is automatically closed and you lose the money you put in. This is why understanding risk is everything in futures trading. When you open Binance Futures for the first time, the interface might look overwhelming. You'll see charts, order books, numbers moving fast, and it might feel like you're staring at a cockpit. But don't worry, once you understand the key parts, it becomes much simpler. The chart is where you analyze price movements. Most traders use candlestick charts because they show you how price moves over time. Each candle tells a story of buyers and sellers fighting for control. Green candles mean price moved up, red candles mean price moved down. Over time, patterns start to form, and traders use these patterns to make decisions. Then you have the order types. The two most important ones for beginners are market orders and limit orders. A market order executes instantly at the current price. It's fast, simple, and useful when you want to enter or exit a trade immediately. A limit order, on the other hand, allows you to choose the exact price you want to enter. It won't execute until the market reaches that price. Now let's talk about margin. This is the money you put down to open a trade. On Binance Futures, you can choose between isolated margin and cross margin. Isolated margin means only the money you put into that specific trade is at risk. Cross margin uses your entire futures balance to keep your position open. For beginners, isolated margin is much safer because it limits your losses to a single trade. One of the biggest mistakes beginners make is jumping straight into high leverage. You'll see options like 20 times, 50 times, even 100 times. It looks tempting because it promises massive profits from small moves. But the reality is, even a tiny fluctuation in price can wipe you out instantly. A smarter approach is to start with low leverage, something like 2 times or 3 times, while you're still learning. Another key concept you need to understand is stop loss and take profit. These are tools that protect you from emotional decisions. A stop loss automatically closes your trade if the price hits a certain level, limiting your loss. A take profit closes your trade when you reach your target profit. Without these, you'll find yourself holding losing trades too long and closing winning trades too early. Now let's talk about strategy, because this is where most people fail. Futures trading is not gambling, even though it might feel like it at first. Successful traders follow a plan. They don't just randomly enter trades based on feelings or hype. They look at trends, support and resistance levels, and market structure. A simple beginner strategy is trend following. If the market is clearly moving upward, you look for opportunities to go long. If it's moving downward, you look for opportunities to go short. You don't try to fight the market, you follow it. This alone can already improve your chances significantly. Another important thing is position sizing. Never risk all your money on a single trade. A common rule many traders use is risking only a small percentage of their account per trade, maybe 1 to 2%. This way, even if you lose several trades in a row, you're still in the game. Because the truth is, losses are part of trading. Even the best traders in the world lose trades. What separates them from beginners is how they manage those losses. Beginners try to win every trade. Professionals focus on managing risk and staying consistent over time. Let's also talk about funding rates, something unique to futures trading. On Binance Futures, traders pay or receive funding fees depending on market conditions. This is used to keep the futures price close to the spot price. Sometimes you'll pay a small fee to hold your position, sometimes you'll earn a small fee. It's not huge, but it's something to be aware of, especially if you're holding trades for a long time. Now, imagine this scenario. You open a trade with high leverage, no stop loss, and no real plan. The market moves slightly against you, and suddenly you're down 50%. Panic kicks in. You either close the trade at a loss or hold it, hoping it comes back, and then you get liquidated. This is how most beginners lose their money. Now imagine a different scenario. You enter a trade with a clear plan. You use low leverage, set a stop loss, and only risk a small portion of your account. Even if the trade goes against you, your loss is controlled. And when you win, your profits slowly compound over time. This is how professionals think. Another thing you need to understand is that trading is not a get-rich-quick scheme. Social media makes it look easy, but the reality is it takes time to learn. You'll make mistakes, you'll lose trades, but each mistake is a lesson, and if you stay consistent, you improve. Before risking real money, it's actually smart to practice using a demo account. Binance offers testnet environments where you can trade with fake money. This allows you to understand how everything works without the risk of losing your funds. It's one of the most underrated steps, but it can save you a lot of money. At the end of the day, futures trading is a powerful tool. It gives you opportunities that don't exist in normal investing. But with that power comes risk, and if you don't respect that risk, the market will teach you the hard way. So if you're just starting out, keep it simple. Learn the basics, use low leverage, protect your capital, focus on consistency instead of chasing big wins. Because in this game, survival is what comes first. And once you learn how to survive, that's when you start to grow. And the truth is, the market isn't going anywhere. There will always be another trade, another opportunity, another chance to improve. The goal is not to win today, the goal is to still be here tomorrow, smarter, sharper, and more in control than you were before.